So I first want to thank Martin and Doug for pulling this together. Very excited to be back here. As a native Chicagoan, in March when I was told we were going to be canceling this over a few inches of snow, I was a little confused. But then again, this is suitable attire for 20-degree weather, so I may be slightly biased. I'm very excited to share the views of my organization and myself about what is happening in the trenches today. A lot of what we're talking about, our objective, is to identify obstacles and roadblocks to financial stability, growth, and innovation. And to do this, I want to share with you some of our direct experiences working with commercial banks, working with corporate treasurers, as they digest this massive fire hose level stream of new regulation and try to manage their business and do all the great things they have to do day to day. To do that, I'm going to share a few examples of what we're seeing with banks. One of the examples was going to be exactly what Tom just talked about, so I'll save you the detail there and give a great big ditto because it is a very big issue. The rest of my examples are going to be about my experiences in commercial banking. We joked earlier about the plight of the poor bond trader. My remarks are going to sound a little bit about the plight of the commercial banker, but I can hope that I can connect the dots for you. Because what we're talking about is the plumbing of the financial system and the infrastructure that needs to support economic growth, stability, and innovation. And at Treasury Strategies, we see those obstacles day in and day out. And a brief note of what Treasury Strategies does, what I do day to day. We are a leading advisory firm in the areas of treasury management, liquidity, payments, and deposits. We consult with the CFOs and treasurers of major multinational corporations, large healthcare systems, and state and local governments. We also consult with major global and retail banks as they deliver the services to the CFO chain to help those things happen. As I mentioned, I'm part of our banking practice, so I work with banks as they deliver payments, liquidity, receivable services to banks as they try to manage their working capital. To level set where we're at, I want to give a little status update on Dodd-Frank. Mr. Berner mentioned in his keynote speech that ultimately in the short term, you need to make a trade-off between financial stability and growth, which I agree with. It makes sense, and especially in the dark days of 2008 and 2010, we needed to make drastic measures to stabilize the economy. But when you think about where Dodd-Frank is today and where we're at, this is not a completed task. Move on to the next thing. Dodd-Frank had 390 rule-making provisions in it. That meant that thousands of pages document, that was 6 pages of printed paper, was really pointed to a lot more paper that was going to be written in the next year. As of first quarter of this year, we're about 60% of the way through. 235 of those rules have been finalized. 84 have yet to been proposed, and another 71 are somewhere in between. So when we talk about our short-term trade-off between stability and growth, what our clients are in today are not the ending act of the play. We're really in the middle of the tortured second act. That 71 and the 84 means there are 150 plus more rules that banks and financial organizations still need to root through. And we're 5 years past the passage of Dodd-Frank. The first example I want to give is actually not related specifically to Dodd-Frank, but another big issue that banks are struggling with. It has to do with the Bank Secrecy Act. So all the work that banks need to do to know their customer and monitor anti-money laundering activities. At the beginning of this year, we were hired by a large community bank in the Midwest to look at the documentation they're collecting from their clients to open checking accounts, because they were telling us they were losing business over this. And we were highly skeptical about this, because these are clients that have already taken in loans from the banks, already set up services, so the idea that something as simple as opening a checking account would be so bad that they would lose business over it. But when we started actually engaging the bank, what we found was actually rather shocking, that they were losing business. This engagement specifically was because an 80-year relationship of the bank, a relationship started by the CEO's father, left the bank over this issue and told the CEO as much. So you can imagine what the CEO's message was to the senior leadership of the bank. And through our interviews about how you collect documentation, what you collect and everything, what we found was there were process issues for sure. And that has a lot to do with the fire hose that's being opened up on banks and that they have to really deftly respond to. The other major issue, though, goes back to this idea that 71, where we're in between the proposed rule and the final rule, what you had was a compliance department and a legal department that were doing the right thing. There is a rule around collecting certain information about what's called beneficial owners, so owners that are not on paper but benefit from the proceeds of the account. The legal and the compliance department was being very aggressive in pursuing that, but the rule was not final. So when bankers had to do all this very hard due diligence that was angering their clients, they looked to the market and they didn't see other banks doing that, and because the rule wasn't final. But when we talked, and this is a major theme we've seen today, regulators say that the proposed rule is very close to final. It's going to happen any day now. And you see a lot of indirect messages that you need to be prepared. Either you're compliant, even though the rule is not final, either you're compliant today or you show me a plan when you're going to be compliant. So this bank, which was trying to do the right thing ultimately, was losing business over that. And again, for something as simple as opening a checking account, I had a commercial loan officer tell me that it was far easier to loan a client $25 million than it was to open up a checking account to hold that money. The second example I want to give that our Mr. Klein brought up earlier was this idea that you have like 2 or 3 solutions to a single problem. And that causes paralysis. We work with some bank treasury departments, and there are 2 big liquidity regulations in place today. One's called the liquidity coverage ratio, and the other is a liquidity buffer that they're supposed to hold related to their stress test. At the simplest level, both of these regulations call on a bank to hold high-quality liquid assets to cover a 30-day stress period. Liquidity coverage ratio is a very specific thing. The banks don't have a lot of leeway to define what that stress period is. And then you have the stress test on the other side, which defines their buffer, which is a very different process. It's their own stress test. But these are 2 distinct processes that they need to run in parallel that attack the same problem. And at the end of the day, what we're surveying corporate treasurers, or bank corporate treasurers now, is how do you rationalize those things? We were having conversations of like, you have an HQLA buffer related to LCR, you have your EPS buffer, and which one is, when you actually ask the simple question, what is your liquidity backstop day to day, that is a very difficult question that is causing a lot of consternation in bank treasury departments. Again, paralysis. Another thing that we are seeing that is probably most disconcerting of all of this is retraction from businesses. We are seeing banks actively exit businesses in a pace that is basically we have never seen before. We've talked about before how a big win of the post-crisis regulatory reform is that we've taught banks to be risk managers, which I agree with. That was a definite gap in there, and now we've taught them. But what is happening now, in the wake of regulatory uncertainty, they are looking at certain businesses and they are exiting them because they don't know the direction of them. Going back to the example around bank secrecy and know your customer, a lot of interpretations of that ultimately means that the banks not only need to know their customer, but they need to know their customers' customers. We have seen a bank exit a large electronic benefit program of a large local government. So debit cards, preloaded debit cards to transfer child support benefits, welfare, and other entitlement costs. We've seen a very large bank exit that business because ultimately they can't do the due diligence on all the holders of the debit cards. Regulation says it's not the state government that's your client. It's ultimately those users of the debit cards who are. The bank simply said, no mas, we can't do it. That's too much. Another example that we see very similar to this are property management. So for all of us in the room today that are part of associations and property managers and that type of thing, it's very easy for you to submit payments through ACH debit. Again, the same thing applies, and banks are backing out of those businesses because they can't do the due diligence on you when their clients are the managers. Thank you very much.
Yeah, more constructive. Far more constructive than my singing, I assure you. Perhaps not surprisingly, given the way we framed the panel, and I thought it was an excellent panel, so thank you all. In some ways, it sounded like a list of complaints about financial reform. So let me start by stepping back and asking each of you, and you can either answer for yourself or for kind of the constituency that you deal with. Overall, is it your feeling that the financial reform efforts have been mostly positive? Do you think the complaints outweigh the advantages? How do you see it? And to the extent that you see negative aspects, do you think they're correctable or you think they're inherent? So,
when I think of this question, I think of it on a timeline. And I think, as I mentioned, the first phase, we're very positive. I think ultimately that Dodd-Frank had the right ideas in mind, and we created the resiliency in the system. But we are now in this tortured second act where you have multiple provisions attacking the same problems. You have a spaghetti of a regulatory system that just needs to be rationalized. I thought the comment about how you have FSOC and you have 10 regulators, and you have one regulator that needs to make a rule that Congress is told to make a rule. The other 9 are pushing them in a direction. There's no accountability for them to do it. And that's the paralysis that's being created in the market. So it's time to declare victory that we've shored up the financial system, find good ways to accelerate what still needs to be done, and ultimately begin to consolidate some of these three-pronged solutions to a single problem.
So 2 drama questions. This is a 5-act play?
I was thinking of Hamlet, but I'm actually stealing from George Lucas talking about trilogies.
They're usually 5 acts, so that's what I'm trying to figure out how far we are along here. And are we talking about a tragedy or a comedy here?
Well, the reality of life is there's a very thin line between the two, and it's yet to be seen.
Okay, that's nicely non-committal. Tom, in terms of the other corporate treasurers who are out there, is the overall feeling about financial reform positive, negative, mixed? Could you characterize it in some way?
Well, I think, Doug, in many cases, the full effect of these regulations hasn't hit yet. Right. And so, for instance, the liquidity regulations for banks that will ultimately be passed through to corporate borrowers won't fully come into effect until January 1st, 2018. And so I think everybody's in a mode of watchful waiting. What I will say is that, and what I was trying to convey is, good and bad are inherently relative terms. The problem that treasurers are facing is just the fact that the regulations are different. So if you're the treasurer of a U.S.-based multinational company, you've got the Europeans requiring different reporting of you for exactly the same transaction that the U.S. requires. In some cases, for instance, the U.S. exempts most inter-affiliate trades. The Europeans require reporting of inter-affiliate trades. So we certainly support the transparency that's intended to be achieved through the swap data repositories and these other places where we're collecting pricing data and providing market transparency. But the question is one of cost and benefit. The regulators aren't coordinating their efforts, and how we do that is, in many cases, for multinational treasurers very burdensome.
Eric, do you have a oral?
Yeah, I mean, thank you. I think Aaron's chart I thought was quite good in terms of the things that, there's broader consensus where we've made some great gains. But ultimately, this is, if you look at the regulatory market or the regulatory system as a whole, I don't think there are too many people who would say this is exactly the way I draw it up, right? I think it certainly needs to be improved in a variety of ways. But one of the fundamental changes, which we think are so important, is the CFPB. And I think the trouble that we have right now, I think from the consumer perspective to some degree, is where are we going to get innovation, right, to be able to free up markets and serve consumers better? Is there going to be a new role with respect to how banks have played in this space or not? I think there's still a lot of questions about that. CFPB was supposed to be doing a little bit more in the innovation space than they are right now, but naturally they're busy doing other things. And I think it's still a big question how we get out of the political environment we are with respect to regulation. And I just mentioned a little bit about how populism is growing and what it's going to mean. And I just don't think we really know around issues of income inequality or for others, really anti-corporate sentiment. And how's that going to manifest in a new administration and a new environment? I don't think we really know. But I'm very concerned about where innovation is going to come from because I feel like that's a really important part of the market of the future.
I was really hoping you had the answers to some of these things. Well, I'm going to get a better panel next time, I tell you. So let me go through. Let me go through each of you in the original order because I jotted down a few questions. Tom, one is just a clarifying question. You mentioned $269 million, which doesn't sound like a lot. Did you mean billion, or is this $269 million average per company, or?
Yeah, it's the average per company, okay. $269 million, and in our world outside of Washington, that's still real money. And it's a direct subtraction of funds that each individual company would otherwise have to invest in its business. And then when we extrapolate that to the S&P 500, we see the job effect on those companies would be 100 to 120,000 jobs would either not be created or would be lost from that kind of activity. That's why it was so important to us.
Right, no, that makes sense. I just wanted to make sure we understood the number there. And you talked a lot about derivatives, and I appreciate your focusing in on something. But what are there other areas of concern for the corporate treasurers on the financial reform area?
Yes. I mean, in terms of funding, the requirements to be imposed finally on January 1st, 2018 under these various liquidity rules for banks will result, as an example, we are an issuer of commercial paper. We use that market to fund our business on a day-to-day basis. If on a given day, just because of market illiquidity or maybe we came late to the market, one of our dealers takes a market-making role and buys some of that paper to roll it over, then there's going to be a requirement that 85% of the funding the bank used to buy that paper under the LCR rules and the net stable funding requirements has to be long-term funding. So they're buying paper that yields 50 basis points with whatever, so the 10-year Treasury is 240 today, whatever premium on top of that the bank funds itself at. That's the kind of mismatch. So what you're going to find is that corporate commercial paper issuance is down because of this well-intended top-down idea that banks should match the balance sheet that we talked about on the earlier panels.
So that actually ties nicely into some of the earlier discussions. Is it a concern of yours as a corporate treasurer, this whole market liquidity issue that's been discussed? Because corporates is one area that a particular concern has been expressed.
Liquidity is the big concern. I mean, as we saw in both in 2008 and preceding that, with all the warnings we had from long-term capital, that event. It's liquidity, liquidity, liquidity. And what I was trying to describe in the derivatives market is that because of these different regulations, counterparties are solving for the least common denominator. I will tell you that there are UK banks who haven't run through all the hurdles to register in the US as a swap dealer. That means that if we trade a derivative with that UK bank, and this is a major clearing bank in the UK that has failed to complete all these tasks, then we are required to report the trade, whereas if it were with a registered U.S. swap dealer, that counterparty would report the trade. So because we're not fully equipped with all the data fields, the 500-something data fields to report the derivative trade, we're just not going to trade with that bank. So that bank will have withdrawn its liquidity effectively from the U.S. market, and it happens in a way that I'm concerned can balkanize and segment into these smaller pockets of liquidity where the counterparties are subject to the same jurisdictions. That's a concern.
Okay, thank you. Scott, one thing that struck me as you were giving your quite lucid presentation is you seem to imply that banks exiting these business was probably a bad thing.
Yes.
Why is that? Because presumably part of what we learned in the crisis was that we had some organizations doing things that they shouldn't have been doing. Is it the particular ones you saw where you felt that they should be able to do this, or?
So there are a few things. Yeah, the first point, that's why I wanted to give the example of electronic benefit cards. Another business we see banks exiting is check cashing at grocery stores. So the unbanked who don't have access to bank branches, they won't have that type of access at stores. So that's one tenet. But if you just think of some of the other ones, we talk a lot about shadow banking. At some point, shadow banking is going to turn into mattress banking because Tom's mentioned LCR. Like, there are big slugs of money out there that no one wants anymore. Money funds can't take it. Banks can't take it. And we're getting to the point that there's no mattress big enough in the world to hide this money under. So it's where does it go? And also, we talk about innovation. And this kind of dovetails with this. Right now, Silicon Valley is a budding cottage industry for payments and for also, like, if you think of Kickstarter and funding, payments and credit. So on unintended consequences, some of this stuff gets pushed out into the fringes that is unregulated. And also more concentration risk. So another thing that we don't talk about a lot today, but just all the clearing banks do for one another. A lot of banks want to leave that business. Large banks clearing checks for other banks. What's happening is it's basically coming down to the Fed and maybe 2 or 3 other banks that process a majority of those checks in a way that wasn't like that 20, 30 years ago. So we've created more concentration risk, more systemic risk.
Okay. And then, Eric, I have a couple questions for you, but let me start with the most basic, maybe most important. Looking out for the interests of the relatively underserved, how do you balance the financial stability risks with the sort of credit availability, service availability objective? That is, certainly there are some who argue that maybe what you might want to see with mortgage rules might store up financial stability risk for later, but you might feel they're necessary for just making sure the credit was available. I mean, presumably you want the exact right rules that work with the perfect balance, but how do you think about achieving that balance?
Sure. There's a couple of good examples. I mentioned one with respect to the mortgage program that we run, a housing counseling network. Part of the reason why the network itself and pre-purchase housing counseling that's tied to a mortgage is so important is because what lenders lacked was information related to those consumers to properly assess their credit risk. And the counselors were able to do certain kinds of activities that enabled them to have more information and mitigate any risk associated with those loans. So they were able to give prime loans rather than subprime loans. And that takes time, it takes energy, it takes resources. But ultimately, the proof is in the pudding in some ways. A lot of the loans that were issued either to immigrant families or low-income LMI families that had counseling associated with it have performed very well through the crisis, right? So there is something associated with that, and that has to do with the ability to assess information and to assess clients in terms of their risk. That tends to be very poorly done with respect to immigrants, for example, who are not necessarily in the system or where you're collecting lots of information enough to make that kind of assessment. Another way of which we're exploring right now is related to citizenship loans. One of the high-cost areas for immigrant families is applying for citizenship. But we know if you go through the process, right, you're more embedded in communities, you're more financially sound, you're more engaged. Can we issue small dollar loans that enable these families to go through the citizenship and legalization process while at the same time collecting more information on repayments that we can use and put them into the system to better assess the risk profile of these families? So there's different ways in which we can mitigate that, but that's an important challenge in markets, is making sure you have enough information. And as we talk about how big data is going to be used or can be used in the future to fuel innovation, carve up segments, apply different kinds of products, that's problematic for segments that don't have a lot of information or there isn't a lot of information on them to be able to make that assessment. So there's a fundamental question in our minds about whether there's some kind of bias already built into the system. It doesn't have anything to do with your risk profile if you don't have any information. But as a result, these are families or individuals that are automatically charged higher costs associated with the loans that they take out just because there's no information. And that, we believe, is problematic.
Okay, and then my second question is, you either, I think you outright stated, but you at least strongly implied, that at this point credit availability is much lower than it really should be. Yeah. Just wonder, from an analytical point of view, how do you tell what it should be?
Yeah, so, well, I'll start and give you the example. Our network was counseling 60,000 per year before the crisis, probably did about 3,000 in loans as a network of 45 to 50 organizations. We're doing half that now, about 1,200 a year, incredibly tight. And again, these are a lot of families that go through a process and ultimately are mortgage ready. The HMDA data, I think, reflects considerable tightening in mortgage markets. So I think that is pretty clear, in terms of where they are. And the question was?
The question was, I'm sure you're absolutely right. You can show there's been a significant decline in credit availability. Right. Is this moving to where it should be? You seem to be implying the opposite, that you think it's overshot.
Yeah, and a large reason for that is because we have families coming through our doors for our community-based organizations who are working with families who realize their low credit risks and should be accessing mortgages and prime mortgages, and yet they can't. Okay. There's down payment issues. There's other kinds of challenges in their local markets. There's much more community lending at the local level than the big banks that are players. But fundamentally, we're seeing the customers, right, and assessing their risk, and their risk profile is very good, and yet we can't get them access to credit.
Okay. Good answer. All right, let me turn to the audience now. And you've all been terrific in the first two times, but let me just remind you of the rules. Please identify yourself. Please ask a question. Not, you might get a little comment in. I know I did myself, but try to keep it as a question, and relatively short if you could. So, anyone?
Thank you very much, Larry Jacko. This has been wonderful, by the way. It's been a great, enlightening morning. But we talk about financial reform as if it's a bolt out of the blue. And it seems to me that when we do talk about it, the only reason we're having financial reform is because of the misdeeds of banks. I mean, they don't want to play within the boundaries. And it's like we wouldn't need prisons if there weren't people creating crimes. So my question is, and Eric, I work for NeighborWorks. I'm one of their, I'm very much in tune with you there. But, a lot of people in his community were absolutely, excuse the expression, raped by banks. And now the banks are asking why we need more reform. So my question is, does the banking industry understand not only the fear that most people feel towards bank and the lack of trust in our financial institutions, but how angry we are. Thank you.
Yeah, I think we're probably going to have to skip that one. The only reason is none of the people up here are bankers. So, all right. So I'm sorry about that one. Bert?
Bertie Lee, banking consultant. This is a question for Mr. Dees having to do with derivatives and in the clearing houses. To what extent are you concerned and your peers concerned about the potential for clearinghouse failure? I know that there's some concern about regulators, but is that something that you and your and peers in the Corporate Treasurers Association have expressed concern about, or have concerns in terms of how the threat of clearinghouse failure might become more evident, and there might be regulatory actions to prevent clearinghouse failure?
Well, thank you. That is a concern, and that's one of the drivers behind our desire not to have mandatory central clearing of our derivative positions, instead to do that with the largely bank counterparties we have, where under the standard form agreement we have for those derivatives, there is a right of offset. So to the extent we've borrowed money from the bank, we owe the bank on a mark-to-market of a derivative position, then we can offset those. That's why we're very anxiously looking at another topic from this morning's earlier panel on bank resolution, because we think that we have a place in line in that there's this agreement to net, but if that's not respected in the resolution process, then we have to repay the bank 100 cents on the dollar for the loan that we've obtained from it, and it pays us 0 cents on the dollar or 10 cents on the dollar, ultimately in the liquidation of its derivative position with us.
Okay. Other questions? Martin?
So this is a question for Eric. You're saying that you have mortgage-ready households that can't get mortgages, and I'm assuming these are from the Hispanic community. Is it their ethnicity? Is it a lack of citizenship? Is it that they don't have established credit records? I'm wondering. Now, I know there are people who don't get mortgages. Our friend Ben Bernanke famously tried to refi his house and didn't. So there are certainly some situations. But give us a sense of what it is in this community that makes it so difficult. Or is it just that the banks are so tight that they won't lend?
Yeah, well, Ben should have went through housing counseling. I think he would have had a better chance. I think it's a combination of things. Certainly, the increase in documentation is out there. It's understood why that's important. And families who have documents and documented employment histories and et cetera have to come through the door. I think in some ways, it's the prototypical, family. They're working hard. They have good income. We can document that income. We're looking at what available products are available at the local level. And we still can't either meet one of the threshold criteria, whether that's down payment assistance at the requisite level. So I think there's a number of issues out there that it's not the issues that we were dealing with before. I think in terms of exotic products, no doc loans, I think it's just a different kind of situation now. And there is a lot more, again, documentation and availability on the immigrant side, of course, because of deferred action and because of a potential legalization program of a great magnitude. More families are gathering documents, preparing the process and positioning themselves for engaging in that process. And so that doesn't feel to me, and certainly not the experience of our folks, as being the issue. It is really the types of products and available supports at the local level.
What would you like to see specifically change? Are there one or two things that would help a lot?
Well, I'd like to see, I keep coming back to innovation, but I think there's plenty of room for banks and credit unions and others to, I think, look at various markets and segments that are not being served. I mentioned the ability to bring, if you bring in more people outside of the financial system into the financial system, you start to gather good information and payment history, which we think will ultimately be important as a long-term matter. So I think the question is, how do you do that? A lot of folks are talking about, for example, smartphones and mobile and what's that going to mean for the future. What we know from looking at our communities is that they're not quite engaging in financial transactions just yet. So I think the question is, what do we need to do, what we can do with financial partners and others to be able to create more innovative pilot projects, to be able to figure out how we tackle some of these big challenges with respect to information, assessment, and the connection to really good either bridge products or ultimately affordable products that bring them into the financial mainstream.
And is there anything on the regulatory side at this point that you think needs to change to help make that happen?
Well, one thing I would say about that is, we've certainly had a fair amount of conversations. We have financial partners as well with our programs in the field, and I think for all of them the issue is regulation, right? And to some extent it gets hard to discern at some point what is real and what isn't in terms of what a bank is willing to do and invest, which is why you can tell they're not all the same, right? Some credit unions are doing very, very interesting things. Community banks are exercising a bit more flexibility at the local level. But then the question is, how do you get that to scale? How do you get that into a way that affects more trends in the marketplace? So we still have those kinds of challenges, but I think some ability to discern, and this is why it's a great compliment what the BPC has been able to do, to bring folks together to try to identify and lift up the actual issues that are taking place in reform and be able to identify what are the regulations that are really causing problems, and problems for consumers just as much as anybody else. How do we fix those, right, versus every problem is a regulatory problem that needs to be eliminated.
Other questions?
Hi, it's Ashit Mehta. This is for Tom. Tom, as you think about FMC, big global company, complex needs, balance sheet, et cetera, you think about bank size. How do you guys think about how do you want to do business with? Would you be better with more medium-sized banks or fewer smaller banks? How do you think about that in this whole too big to fail? Because there's this element of large corporations and what they need that is quite different from what most of the rest of society needs.
Well, I think because we are a large multinational company, having banks that can meet our needs in multiple countries is important. But there are plenty of banks who are quite willing to provide their capital with very little ancillary business coming back their way. I think there was a time when Japanese branches in New York were providing up to 1/3 of the corporate lending. It's less than that now, but they're still very active. They will be the first to tell you they can't process your checks or provide other cash management services, but they do have branch networks elsewhere in Asia and would be happy to help in that regard. So it's just a mix of banks providing credit and non-credit services in a balanced way that meets our needs. What I'm concerned about is when Basel III is fully implemented and the reserve requirements and the capital requirements are fully there, that there will be this continuation of banks withdrawing from business segments so that they really can no longer do anything for you except perhaps lend money, which they will not do alone.
Before I forget, when we finish with this panel, don't go away. Martin's going to tell you where the food is. So are there any other questions? Yes, in the back there.
Bob Samuelson, The Washington Post. This is for Mr. Dees. I lost you a bit on your example where the imposition of the liquidity requirements was going to impose a cost on your commercial paper. Do you want to just go over that again?
The concepts behind the capital requirements for banks And let me just say that Doug talked about, is this a Shakespearean play we're in? I think it's really a Roadrunner cartoon. And the corporate treasurer is the coyote who falls off the cliff and makes it to the bottom, but then he looks up and the cliff edge is coming down on him. And for us, that cliff edge is that we may have been exempted from some of these direct requirements to say post-cash margin for derivatives, but where it comes back is through capital requirements on banks that they then have to charge when they engage in those services with you. So the capital requirements for a bank acting as a commercial paper dealer requires that if it buys commercial paper even overnight from one of its corporate customers it's taking out into the commercial paper market, then it has to hold long-term funding against that amount that it buys. So this commercial paper that I'm talking about, maybe it's paying 50 basis points, but the bank has to go and fund that 85% of it under the LCR rules with long-term funding. And I cited the recent 10-year Treasury quote at 2.4% with the spread that the bank earns on top of that. Let's just round it up and say that it's going to pay 4%. So it's almost a factor of 10 or 8 or 9 that the bank is going to pay over and above what it's earning on that instrument that it buys from us. So what we're going to be faced with is that commercial paper dealers will no longer facilitate the placement of our paper through an occasional overnight purchase. It's way too far underwater for them.
Yeah, Bob, if I could expand on that a little bit. Basel III puts in place 2 sets of liquidity rules, which didn't exist before. Liquidity coverage ratio and a net stable funding ratio. The net stable funding ratio calculates how effectively what Tom was doing was carrying that down to the individual transaction level. So if you do that, it says you calculate your total net stable funding ratio, the total net stable funding that you're required to have. You calculate that based on looking at each of the assets and looking at what you would need to back them according to these rules. If the net stable funding ratio is calibrated so it's binding on the bank, that is, it's at a point where it has to worry about it, because some banks will have a margin for error, and then they won't need to think of it so carefully. Then there's going to be a tendency to take that down to the business line level and say, if you're going to be doing this business that has this net stable funding requirement, then you better earn enough to pay for us to get that funding. So I think there are a couple steps that would have to be true to go all the way from the top to the transaction level, but there is a chance it will happen, and certainly for some banks, they will carry it through that way. Then if they do, it's exactly as Tom was saying. It's as if the regulators in those cases had flat out said, you have to go borrow long-term to fund this overnight. And that's expensive.
And we've worked with banks on that very question. When you're dealing with those costs, do you apply it at a business line? Can you apply it to the individual customer? And ultimately, do you bear the cost, or is that cost back? Those are day-to-day conversations I have with banks today.
Yeah, and part of it, because these haven't fully come into place yet, we don't know whether most banks are going to find they've got enough margin for error, that enough net stable funding in general that they don't have to get that picky about it, or whether this really is going to be pretty binding and will end up having real pricing and availability effects.
And the numbers I'm citing, it's roughly an order of magnitude difference. So,
yeah,
I mean, they may not take it all the way down. They may not have their calculator set for 8 decimal places, but it's going to mean they're less able to do that trade that they would have done readily before the imposition of these new rules.
Yeah, I don't think anybody would argue about the direction. What we're still collectively trying to figure out is what the magnitude is and what segments it'll play out in. Sorry, question?
It's Ashit Mehta again. This is for Eric. Eric, you talked about innovation, smartphones. A lot happening over there, but the segment that you're talking about hasn't really embraced that yet, and you touched upon that. What needs to happen to get much more adoption and change in behavior?
Sure. It's a good question. I think one is that we need much more information on usage and purposes. And then I think we need to deal with and address, quite frankly, one of the bigger issues around confidentiality of information and use for particular individuals, certainly if they're doing and engaging in transactions of any kind, whether it's commercial or any kind of banking that's done over the phone. And we haven't quite been able to get over that hump, at least for now. I think some work is going to be needed before we do. But, I mean, we're already seeing lots of different interesting and innovative apps being created for the purposes of trying to introduce new segments to different kinds of tools via your phones. So I think we'll pay a lot of attention to that very, very carefully. But ultimately, some of these confidentiality questions are quite big ones for the community that we represent.
Okay. Please join me in thanking our excellent panel. Thank you very much.
And we have until 12:45. Please